For more on the U.S. economy, Daniil, Manaenkov, head of U.S. forecasting at RSQE at the University of Michigan, joins us. Good to see you again. These numbers, I think the last time we talked, we were looking for data points that show that things would peak. We had a better than expected CPI numbers last week. The PPI seems to have confirmed what many have suspected, that we are in the last stages of this crazy inflation that we have seen for the past 6 to 9 months. Do you agree?
I think it's a little too early to celebrate. If there's one thing we know about inflation, at least consumer inflation, that it is persistent. So I think markets are getting a little bit ahead of themselves, acting like this good report, that unquestionably good report that we got in October, is going to be repeated. And I think the jury is still out on that one. I would not be surprised if monthly rate of inflation jumps back to somewhere close to 5%. And there's another question. So what we have seen so far is CPI and PPI, but what matters most is the deflator for personal consumption expenditures inflation. And that one is calculated a little bit differently than the CPI and the PPI. And it's not clear that what we have seen so far in October is going to filter through. So I am a little bit hesitant to call it like beginning of a significant deceleration. I think we're still going to be decelerating, but it's still far from clear that we're going to see a meaningful and quick acceleration that merits, I don't know, 7% increase in stock markets over a week.
Right. Lyle Brainerd of the Federal Reserve, you know, people have quoted her saying that this is near the peak and the Fed might be able to bring down the pace of increases. It's been 75, 75, and 75, and so on. Maybe they do 50, maybe they do 25, or maybe they do the waiting game and they wait. I mean, that's one thing that they have been fairly consistent, is that they've said that this isn't going to happen next month. It's going to take 3 to 6 months at a minimum before we see the impact of these rate increases on the economy. Where does that leave the Fed in December and in Q1 of next year?
Right. So I'm going to channel Chair Powell, who said that we should focus not on the very immediate increases in their size, but really on the terminal rate. And in recent days, we have seen the terminal rate projections, so that is where the Fed is going to, where the Fed funds raising cycle will peak, come down from like 5.5% to maybe under 5%. And I think that's a little bit of an overreaction. I think the Fed is going to be slowing the pace of increases in the coming meetings. So it's likely that we're not going to see 75 basis point increases again. But I think it's still going to be, I don't know, 3 more meetings of increases at the very least. And after that, the Fed may pause for a while and wait.
If you look at the bond market, you know, with the long-term bond yields now below the short-term bond yields, as we call it in the business, it's inverted, which indicates that someone is betting on a hard landing in the economy, that they would have to eventually cut rates. Yet the optimists would tell you that we're having a soft landing. So you have the stock market being optimistic, the bond market being very skeptical of all this, and they both cannot be right at any given time. Which camp are you in?
Right. So I mean, the past 2 years have been like that. There are a lot of signals that are contradictory. We are in the camp that there is going to be a mild recession, not immediately, but sometime in the second half of 23. And that's going to bring down inflation more meaningfully. So we think in the near term, we are still going to see increases in rates, in the short rates and maybe in long-term rates. But in the medium term, I think inflation is going to come down, but without a hard landing at the moment.
These layoffs, all of the business shows, including ourselves, are very focused on what's happening in Twitter and all these big companies like Meta. But there are thousands and thousands of smaller, medium-sized companies that really are struggling. And they are laying off people, or at minimum reducing hours or reducing overtime. And those are never calculated in the statistics that we read out here. But I know they're there because I hear people talking about them, and I confirm it with the bosses of these people. And you see the job losses mounting at big companies, medium-sized companies, and small companies. What does that tell you, or how do you view that from a data point? Is it positive in the sense that things are slowing down, or is it transitory or an adjustment, as some would call it?
I mean, obviously there is a trend in slowing down of payroll job growth, and we have seen it over several months. And just like I said, there are many bits of data that are contradictory. So if you were to look at the household survey, where the Bureau of Labor Statistics sends out a survey and asks people, are you employed and are you working? That survey has been lagging what businesses report. So maybe there's something happening. The big survey that we all keep our close eye on is what is happening with unemployment claims. And this is where you would typically spot the sign of trouble first. And that survey is maybe inching up just a hair, but it's still at a very, very, very low level. So I think we will have to see a lot more significant moves in initial claims for unemployment before we should be getting worried. That said, the economy is typically very, very dynamic. So there are sectors that are laying off people, but there are also sectors that are hiring.